Margaret stood in her three-bedroom house, worried about retirement at 62. David scrolled through his bank account at 45, wondering where his six-figure salary had gone. Emma sat in her perfectly curated apartment at 31, secretly stressed about her empty investment account. And Tyler, at 23, just bought another pair of limited edition sneakers while his brokerage account held $17. For people, for generations. One devastating mistake. And chances are you're making it right now. Here's what nobody tells you about money. Every generation thinks they figured it out differently than the one before. Boomers bought houses. Gen X climbed corporate ladders. Millennials collected experiences. Gen Z invests in crypto and index funds. Different strategies, different economies, different values. But underneath all these differences, there's a pattern, a financial trap so subtle, so perfectly disguised as success that it catches nearly everyone. And today, we're going to expose it. Let's start where most financial stories in America begin, with a house, a dream, and a generation that believed they had cracked the code. Margaret bought her first home in 1983. 3 bedrooms, 2 baths, a backyard big enough for kids. She was 28 years old, and she did what everyone told her was the smartest financial move possible. She put everything she had into that down payment. Over the next 3 decades, Margaret poured every extra dollar into that house. New kitchen, finished basement, landscaping, home equity line of credit to renovate the master bath. The house became her identity, her security, her retirement plan. Today, that house is worth $700,000. Sounds incredible, right? But here's what Margaret didn't see coming. Property taxes eat $400 every month. Maintenance costs average another $300. The house is too big now that the kids are gone, but downsizing in her area means she'd barely break even after selling costs and buying something smaller. Most importantly, that $700,000 isn't liquid. It doesn't pay her bills. It doesn't generate income. Her entire net worth is locked in walls and windows. Margaret didn't make a mistake by buying a house. She made a mistake by believing the house was wealth itself, rather than just one piece of a larger financial picture. She confused the asset with the strategy. And she's not alone. David got his first major promotion at 32. Suddenly, his salary jumped from $55,000 to $85,000. He felt successful, so he bought a car that looked successful, leased a nicer apartment, upgraded his wardrobe, started eating out 4 times a week instead of 1. By 38, David was making $130,000. The car got nicer. The vacations got longer. The watch got Swiss. Here's the thing about David's story. His income tripled over 15 years, but his savings rate, it barely moved. At 25, he saved 8% of a $40,000 salary. At 45, he's saving 12% of $150,000. Sounds better, right? But it's not, because his lifestyle expanded to match every raise. The financial term is lifestyle inflation, but that sounds too clinical for what actually happened. David started performing the role of a successful person before he actually became financially secure. Every promotion felt like permission to spend. Every bonus became a justification for an upgrade. And now, at 45, David has a life that looks exactly like success is supposed to look. Except his retirement account is 15 years behind where it should be. He drives a car worth more than his emergency fund. He wears success like a costume, but underneath, the foundation is hollow. Emma graduated college in 2009, right into the worst job market in generations. She watched her parents' generation lose homes, saw retirement accounts cut in half, heard endless lectures about homeownership and hard work from people whose economic reality no longer existed. So Emma made a different choice. She decided to live, to experience, to prioritize memories over mortgages. Bali, Iceland, Portugal, Brooklyn rooftop bars, Coachella, bottomless brunches, the perfectly plated dinner that cost $48 but looked incredible on Instagram. Emma wasn't being frivolous. She was being intentional about joy, about not waiting until 65 to actually live her life. The problem is, somewhere between rejecting her parents' path and creating her own, Emma started confusing experiences with investments. At 31, Emma has incredible stories. She's been to 23 countries. She can recommend the best speakeasy in Austin, the perfect taco in Mexico City, the hidden beach in Thailand. But her retirement account has $3,800 in it. She rents, has no investments outside a small Roth IRA, and her savings account fluctuates between $2,000 and $5,000 depending on the month. Emma didn't choose experiences instead of assets as a conscious strategy. She convinced herself that the experiences were the point, that living richly meant spending richly. And now the gap between her lifestyle and her net worth grows wider every year. Tyler is different. Tyler actually knows about compound interest. He watches finance YouTube. He understands index funds, knows what a Roth IRA is, can explain dollar cost averaging. Tyler is more financially literate at 23 than most 40-year-olds. And yet, Tyler just spent $800 on sneakers he'll wear 5 times. He buys $4 cold brew every morning, but contributes $50 a month to his investment account. He owns a closet full of streetwear brands, but hasn't built a 3-month emergency fund. Here's what makes Tyler's version of this trap so interesting. He knows better. He genuinely understands the math. But Tyler grew up in an economy of aesthetics, where financial success isn't just about having money. It's about looking like you have money, where your portfolio matters less than your fit, where investing is something you post about, but spending is something you live. Tyler performs wealth on social media, while building almost none in reality. He's caught between knowledge and behavior, between understanding compound interest and buying things that depreciate immediately. So what's the common thread? What's the one mistake that Margaret, David, Emma, and Tyler all made? They confused the signal with the substance. They mistook the appearance of wealth for the reality of wealth. Margaret thought a valuable house meant she was wealthy. David thought an expensive lifestyle meant he was successful. Emma thought rich experiences meant she was living richly. Tyler thinks looking wealthy is the same as being wealthy. Every generation does this differently, but they all do it. They optimize for what wealth looks like instead of what wealth actually is. And here's why this trap is so dangerous. The things that signal wealth, the house, the car, the vacation, the outfit, those things feel like investments in your identity, in your status, in your happiness. They feel important. They feel like progress. But they're not assets that work for you. They're expenses that you work for. Real wealth isn't what you can show. It's what you've stored. It's not the car in the driveway. It's the investments that could buy 10 of those cars, but you choose not to. It's not the house that contains all your net worth. It's a diversified portfolio that happens to include some real estate. It's not the experiences you leverage credit cards to afford. It's the freedom to choose experiences because you've built the foundation first. So how do you escape this trap? How do you build actual wealth instead of performance of it? The answer is deceptively simple, but incredibly difficult to practice. Assets first, lifestyle second. Not assets only. Not never enjoy your money. But first, the foundation before the facade. The substance before the signal. This means you invest before you upgrade. You build your emergency fund before you book the trip. You max out retirement contributions before you lease the luxury car. You create passive income streams before you inflate your lifestyle. And yes, this requires patience in a world that rewards the appearance of having already made it. It means you'll look less successful than your income suggests you should. It means delayed gratification in a culture built on instant everything. But here's what it actually creates. It creates options. It creates security. It creates the genuine freedom that everyone performing wealth is trying to simulate. Because the bitter irony is that all these status signals, the house, the lifestyle, the experiences, the aesthetic, everyone's chasing them to feel secure and free. But the pursuit of looking wealthy is exactly what prevents you from becoming actually wealthy. And actual wealth is what gives you real security and real freedom. Margaret, David, Emma, and Tyler aren't real people, but their stories are absolutely real. They're composites of millions of Americans across every generation, making the same fundamental error in different clothes. The question isn't whether you've fallen into this trap. If you're human and live in a consumer culture, you probably have in some form. The real question is, what are you to do about it now? So here's what I want you to do. Look at your last 3 months of spending. Be honest. How much went to building assets versus funding signals? How much went to actual wealth versus the appearance of it? Drop your answer in the comments, not the specifics, just the ratio. And if this video gave you a new perspective on your finances, share it with someone from a different generation, because this trap doesn't discriminate by age. It just evolves. Thanks for watching. Subscribe if you want more financial psychology that actually makes sense. And remember, wealth whispers while poverty shouts. Build quietly. The results will speak loud enough.